Have you ever wondered how the massive real estate deals around the world could impact the local market in your area? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Driven by mounting liquidity pressures and strategic repositioning, Vietnam's real estate market has witnessed a significant increase in large-scale asset transfers during the first half of the year, according to Vietnam Investment Review. In June, Vietnambank announced it was undertaking procedures to transfer ownership of its landmark Vietnambank Tower project, located in the Nam Thang Long urban area of Hanoi, with an asking price of approximately $400 million. The development occupies nearly 3 hectares and comprises 2 high-rise towers of 48 and 68 stories. Despite a total investment exceeding $400 million and construction commencing in 2010, the project remains unfinished due to various challenges faced by the bank. Phan Xuan Can, a real estate merger and acquisition expert based in Hanoi, highlighted that Vietnambank's move aligns with several new advantages in the current market, including low interest rates, improved real estate liquidity compared to last year, and growing investor appetite. Can emphasize the need for a well-capitalized investor with a long-term outlook to make the deal viable. In another major transaction, Hanoi Anpha Real Estate Exchange acquired over 48.4 million shares, equivalent to a 23.06% stake, in Vinaconex's tourism development and investment for approximately $94 million. This company is the developer of Cat Ba Amatina in Haiphong, a 170-hectare coastal urban tourism complex. Meanwhile, Gateway Thu Thiem JSC acquired a 42% stake in Nam Ruch Cheek Company, the developer of Palm City in Ho Chi Minh City, from Singaporean real estate group Keppel for $104 million. On the seller side, Vinhomes transferred a 25-hectare subdivision within Vinhomes Ocean Park, 3 new urban development area in Van Giang of Hung Yen Province, to Singapore-based Capitaland. Capitaland plans to develop nearly 700 low-rise units across 2 phases, with a total expected investment of around $800 million. Despite these developments, the real estate merger and acquisition market has yet to reach a true breakthrough due to ongoing obstacles such as legal uncertainty and pricing challenges. Many projects continue to face procedural bottlenecks, limiting the volume of transactions. Successful deals have occurred when sellers are realistic and factor in buyer profitability. Most merger and acquisition activity in 2025 has focused on urban residential developments, with other segments remaining subdued. However, Phan Xuan Can remains optimistic about the outlook for the rest of the year, as legal bottlenecks are gradually being addressed, capital availability is improving, and overall market sentiment is strengthening. According to the latest report by Jones Lang LaSalle, India's retail real estate sector experienced a significant 69% year-on-year growth in leasing activity during the first half of 2025. The top 7 cities in India recorded a total of 5.7 million square feet of retail space leased. However, the second quarter of 2025 saw a short-term decline with 2.6 million square feet leased, down by 15% from the first quarter due to a lack of new supply. The report highlights that there was a 165% year-on-year growth in new mall supply in the first half of 2025. Notably, Mumbai, Delhi NCR, and Hyderabad saw substantial mall supply become available in the first quarter. The first half of 2025 has already achieved 70% of the total leasing volume recorded in 2024, which was 8.1 million square feet. Bengaluru and Delhi NCR emerged as the top performers in retail leasing, contributing a combined 46% of the gross leasing volume in the second quarter. Bengaluru leased 0.67 million square feet, driven by strong demand in the jewelry and home furnishing sectors. Meanwhile, Delhi NCR leased 0.53 million square feet, with food and beverage dominating the leasing activity. Other cities like Hyderabad and Mumbai also showed significant activity, adding 0.51 million and 0.49 million square feet of leased space, respectively. Fashion and apparel led the retail leasing categories in the second quarter, accounting for 33% of the gross leasing, followed by food and beverage at 22%. Jewelry leasing overtook entertainment, capturing a 9% share, primarily in South India and the Delhi NCR region. International brands are making headway in India's retail market, with domestic retailers holding 85% of the market share in the second quarter. 13 new international entrants were recorded, with 7 in the food and beverage sector, leasing a total of 0.4 million square feet. Bengaluru alone contributed a quarter of the national retail leasing, positioning itself as a hub for new store launches. Looking ahead, Jones Lang LaSalle projects nearly 5.9 million square feet of new retail space to become operational in the second half of 2025, with new malls anticipated in Delhi, NCR, Bengaluru, Hyderabad, and Pune. The report suggests that these additions will push the gross leasing activity beyond the 10 million square feet mark for the year 2025. The retail sector is undergoing a seismic shift as electronic commerce, shifting consumer behaviors, and mall obsolescence collide with traditional brick-and-mortar models. JCPenney's real estate liquidation, managed through the Copper Property CTL Pass-Through Trust, epitomizes this transformation. By 2025, the company's 121 net leased retail properties, spanning 16 million square feet and 35 states, will either be sold or restructured, reflecting a broader trend where commercial real estate and private equity firms are redefining how retail assets are valued and deployed. JCPenney's post-bankruptcy strategy, initiated in 2020, has prioritized asset monetization to reduce debt and fund its pivot toward electronic commerce and omni-channel retailing. The Copper Property CTL Pass-Through Trust, which oversees the liquidation of 160 retail properties and 6 distribution centers, has already sold 28 stores and all distribution centers by mid-2023. The remaining retail properties are leased to JCPenney under a triple net lease, with a hard deadline of July 2025 for full liquidation. If unmet, certificate holders can convert the trust into a real estate investment trust, a move that could unlock liquidity for investors while stabilizing returns. This process highlights how commercial real estate is becoming a critical lever for retailers to navigate financial distress. The Copper Property CTL Pass-Through Trust's portfolio, located in high-growth Sunbelt markets such as Austin, Houston, and Miami, and major metropolitan areas, is being marketed by Newmark and Hilco Real Estate. These assets, generating $100 million in annual rent with consumer price index-linked escalations, are attracting institutional investors seeking stable cash flows in a low-vacancy retail market. The liquidation underscores the growing role of private equity and real estate investment trusts in revitalizing retail assets. Firms like Hilco Global, which manages the Copper Property CTL Pass-Through Trust, and Newmark Group, which brokers the sales, are capitalizing on mall closures and electronic commerce-driven dislocations. These players are not merely selling properties. They are repositioning them for new uses, such as mixed-use developments, logistics hubs, or experiential retail spaces. For example, the Gateway Center in Brooklyn and Newport Center in Jersey City, 2 high-profile JCPenney properties, could transition into mixed-use complexes, blending retail with residential or office spaces. This trend mirrors how private equity firms like Brookfield and Simon Property Group have historically repurposed mall assets. The current low vacancy rates, 1.8% as of the second quarter of 2025, and limited new retail development in the United States further amplify the appeal of these properties to investors. JCPenney's store closures, 8 by mid-2025, including locations in California, Colorado, and Maryland, reflect the existential threat posed by electronic commerce. Online sales now account for 20% of JCPenney's revenue, up from 5% in 2020, as the company shifts its focus to digital engagement and personalized marketing. However, this transition has left a trail of vacant mall spaces, with Coresight Research predicting 15,000 United States store closures in 2025 alone. The irony is that the same electronic commerce boom driving store closures is also fueling demand for commercial real estate. Logistics hubs, fulfillment centers, and last-mile delivery facilities are commanding premium valuations, while mall properties in prime locations are being rebranded as flexible assets. JCPenney's liquidation process exemplifies this duality. Shuttered stores become opportunities for real estate investment trusts and private equity to repurpose assets in alignment with new market demands. For investors, the JCPenney liquidation and broader retail real estate shifts present both risks and opportunities. Real estate investment trusts, like Simon Property Group and Prologis, are well positioned to benefit from mall repurposing and logistics demand. Real estate investment trusts with a focus on high-growth Sunbelt markets, such as Austin and Houston, could outperform as demographic trends drive commercial real estate values. Firms managing liquidation trusts, like Hilco Global, and commercial brokers, like Newmark, stand to profit from asset turnover and advisory fees. Their stock performance is closely tied to the pace of retail restructuring. Investors with capital can target undervalued mall properties in Sunbelt regions, where population growth and low vacancy rates justify redevelopment into mixed-use or logistics-focused assets. While JCPenney's new entity, Catalyst Brands, aims to leverage its 650-store footprint and digital integration, its success hinges on execution. The stock remains speculative, with earnings volatility likely until the liquidation concludes. JCPenney's liquidation is a microcosm of the retail sector's evolution. As electronic commerce erodes traditional models, commercial real estate and private equity are stepping in to redefine asset value. The Copper Property CTL Pass. Through Trust's July 2025 deadline serves as a litmus test for how quickly these transitions can occur and how profitable they can be for stakeholders who position themselves early. For investors, the key lies in balancing caution with opportunism. While mall closures signal the end of an era, they also open doors for innovation in real estate and retail. Those who recognize the interplay between asset liquidation, real estate investment trust growth, and electronic commerce adaptation will be best positioned to capitalize on the next phase of the retail revolution. In the second quarter of 2025, commercial real estate investment in the Asia-Pacific region surged to $31.2 billion United States dollars, marking a 15% increase year over year, according to a report by Jones Lang LaSalle. For the first half of 2025, the total investment volumes reached $67.6 billion United States dollars, reflecting a 17% rise compared to the same period last year. This growth comes despite cautious market sentiment and extended due diligence processes due to ongoing economic uncertainties. South Korea led the region in year-on-year growth for the second quarter, with a remarkable 72% increase, totaling $6 billion United States dollars in investments. This growth was primarily driven by the office sector, which accounted for 77% of the total market volumes. Sellers in South Korea are divesting proactively to avoid potential oversupply in central business districts. Japan continued to be a strong performer in the region, with commercial real estate investments reaching $7.6 billion United States dollars in the second quarter, a 31% year-over-year increase. The office sector was dominant, with domestic investors being particularly active. The living sector also saw significant interest, with its highest quarterly volume since the first quarter of 2022, attracting attention from Japanese real estate investment trusts and foreign buyers like Warburg Pincus and Capitaland. According to a survey conducted by Jones Lang LaSalle of 75 Asia-Pacific-based investors, the industrial and logistics sectors, along with energy and infrastructure, are perceived as facing the most geopolitical risk over the next 5 years. Conversely, sectors like living, life sciences, and healthcare are viewed as more insulated due to their reliance on domestic market demand. Stuart Crow, Chief Executive Officer of Asia-Pacific Capital Markets at Jones Lang LaSalle, highlighted the resilience of the Asia-Pacific commercial real estate market, noting the region's ability to attract global capital despite economic and geopolitical challenges. He pointed out that South Korea's office transactions in Seoul reached their highest level since the second quarter of 2021, facilitated by increased capital deployment from domestic institutions and reduced financing costs. The office sector led investment activity in the second quarter of 2025, accounting for $13.3 billion United States dollars in transactions, a 24% year-over-year increase. In South Korea, office volumes reached their highest quarterly level since the second quarter of 2021, while Japan saw strong domestic participation. Industrial and logistics investments climbed to $6.3 billion United States dollars, up 12% year-over-year, while retail transactions totaled $5 billion United States dollars, a 4% increase. The living sector continued to gain momentum, with investments reaching 3.6 billion United States dollars in the second quarter, a substantial 92% increase from the previous year. Japan remained the dominant market in this sector, contributing over half of the region's total living investment volume. Private wealth investment volume surged by 32% year over year to 4.7 billion United States dollars in the second quarter of 2025. Offices were the most favored asset class for private wealth investors, accounting for 45% of all transactional activity, a significant increase from the previous year's 28%. Pamela Ambler, head of investor intelligence for Asia Pacific at Jones Lang LaSalle, noted that central banks across the region are continuing their rate-cutting cycles, leading to a declining cost of debt. This creates a more favorable environment for transactions and is expected to further stimulate investment activity. Despite underwriting slower growth scenarios, markets like South Korea and Japan continue to demonstrate resilience, offering opportunities for long-term growth amidst economic turbulence. Nuveen, an investment manager and its sustainable commercial real estate financing solutions business, Nuveen Green Capital, have made headlines with the announcement of their successful capital raise. They have secured $785 million in new capital commitments for their Nuveen CPACE Lending Fund 3. This fund is specifically aimed at enabling insurance investors to finance energy efficiency and sustainability projects within commercial real estate. This initiative is part of a broader public-private financing program known as Commercial Property Assessed Clean Energy, or CPACE. This program operates at the state level and offers building owners and developers a unique financing mechanism. It allows them to access capital to fund improvements that enhance energy efficiency, water conservation, and climate resiliency. The repayment of these funds is made through an assessment on their property tax bill, presenting a more affordable alternative compared to mezzanine debt and equity. The announcement of this fund marks the third vintage of Nuveen's CPACE lending funds. This follows Nuveen's acquisition of CPACE financing company Greenworks in 2021, which was later rebranded as Nuveen Green Capital. This acquisition was a strategic move to establish a strong foothold in the clean energy and energy efficiency lending market. Nuveen has revealed that its CPACE strategies now manage over $6 billion in assets under management. Joseph Pursley, the head of insurance for the Americas at Nuveen, commented on the significance of this initiative. He emphasized that while sustainability and impact remain crucial considerations for insurers and their investments, there is also a growing priority on longer-duration investment-grade asset-backed securities that offer attractive risk-adjusted returns. Pursley highlighted that Nuveen Green Capital's CPACE strategies cater to these needs, providing solutions that drive greater climate resiliency while being capital efficient, meeting risk requirements, and offering the scale that insurers seek in their investment portfolios. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.